to the lowest gold and silver prices in the industry. SD Bullion recently claimed a spot on the prestigious Inc. 500, making them one of the fastest growing bullion companies in the United States. With low bullion prices and over-the-top customer service, SD Bullion is setting the standard for precious metals transactions. Visit www.sdbullion.com today. Start saving on every precious metals purchase you make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is Michael Pento from Pento Portfolio Strategies. Michael is also the author of the book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Michael, thank you so much for joining us today.
Thanks for having me on, Elijah.
All right, well, I'd first like to discuss your book. Now, in your book, you write about how we're currently in the biggest asset bubble in history, and it's about to pop. Can you talk about this?
Well, sure. So the biggest asset bubble out there right now, in my view, is the entire global bond market. You think about what the Fed did in 2003 and 2004. They took interest rates down to 1% for 1 year, and that engendered the housing bubble. Well, what they've done now is they've taken interest rates down below 1%, so 1% or less, for 100 months. And that has engendered the biggest bond bubble and fixed income bubble that we've ever seen. And, of course, if you take down the risk-free rate of return on sovereign debt to 0%, you deform all other assets that are priced off of that risk-free rate of return. So that's municipal bonds, it's any kind of fixed income asset. It affects real estate, it affects stock prices. And it wasn't just the United States Federal Reserve. All central banks in the developed world have done similar things. If you look at Japan, they have a 0% policy on their 10-year note. That's an insolvent nation with an inflation target of 2%, a debt-to-GDP ratio of 240%, and yet their 10-year note yields 0%. The ECB, the European Central Bank, is much the same way. So what we have here is, at its peak, $14 trillion worth of negative yielding sovereign debt. And you think about that for a second, let that sink in, that governments were actually getting paid to borrow money to the tune of $14 trillion. And that's 14% of the $100 trillion global bond market. So indeed, we haven't solved any of our problems. We've created a whole bunch of new problems that will have to be dealt with once the Fed begins to normalize interest rates, and we see that they already started that, and we see that the problems, in my view, are very, very imminent.
Now, you just noted about, negative interest rates on some sovereign debt. What other new insights or new happenings have expanded this bubble a little bit more since you wrote your book in 2013?
Well, I wrote the book in 2013, and we had 3 iterations of quantitative easing, but the U.S. was primarily alone when that occurred. We were joined then, the Federal Reserve was joined then by the ECB and the Bank of Japan. So you have all 3 biggest governments in the world, and in China, who knows what the heck the Chinese government's doing. They manipulate everything. They manipulate stock prices, they manipulate GDP, they manipulate their currency. So you have really China, Europe, Japan, the United States, all in the same boat, concurrently manipulating the yield down to the record low levels. And again, that has engendered a record high price in real estate values. It has generated a stock market bubble. If you look at the total market cap to GDP, if you look at price to sales, median PE ratios, the cyclically adjusted PE ratio, all those metrics scream a massive overvaluation in stocks. And if you have a stock market that's trading at an all-time record high and GDP growth in the United States with a 1% handle, you look at the non-farm payroll report that came out this Friday, 98,000 net new jobs created, and yet the Fed is hell-bent on raising interest rates, flattening the yield curve. I actually think, for the record, that's the exact right thing to do, but they don't understand that they are sending us into the same situation as 2008. This is a 2008 redux. The same thing happened in 1999, 2000, 2007, 2008. Stock prices lost 50% of their value, and I believe we're very close to the same type of phenomenon probably later this year or the very latest early next year.
Now, when the debt bubble pops, you say there's going to be this interest rate shock. Can you expand on this?
Well, interest rates don't belong at 0%, Elijah. So if you, let's take Japan, for example. Why would anybody loan money to the Japanese government and receive a 0% nominal return for 10 years when the Bank of Japan has an inflation target of 2%? So you're guaranteed, according to theory, if they're correct, they can engender a 2% inflation target, and I have no doubt in my mind they eventually will. Japanese currency is down significantly. The yen is down significantly against its trading partners in the last few years. And you see a 2% inflation target, and who would ever loan a government money and expect 0% return in nominal terms and negative 2% in real terms at a very minimum? So who would do that? So what I'm trying to tell you is that if reality ever comes back to the bond market, in other words, if central banks ever have to revert to removing their thumb off of the scale in bond prices and allow them to fall, then interest rates would rise from 0% where they are today in Japan to somewhere well north of 2% in a matter of days, very, very quickly. And not just 2% in my opinion, because that's just the inflation target of Japan. They also are an insolvent government, as I mentioned before. So what would you expect to garner from the BOJ if you were going to loan them money and you knew you were never going to get paid back and inflation was running at 2%? I would submit to you it would be much higher than 2%. It would be in the double digits. Look at what happened with Greece when, back in 2012, when the global bond market deemed Greek government to be insolvent, they took the Greek 2-year note to 300%. So without the intervention of the ECB and the BOJ and the U.S. Federal Reserve, interest rates would be much, much higher. So then you have to say, well, Michael, what happens if central banks never remove their thumb from the scale? They never stop printing money. Well, then you'd have hyperinflation, and perhaps every other asset in the world would skyrocket in price, and the purchasing power of your money would erode, even though you probably wouldn't see yields go up that far because they'd keep buying everything that was ever issued. So eventually, I believe in mean reversion, and I believe interest rates will have to mean revert. And in the case of the United States, that means 7% on the U.S. 10-year note. And if we had to pay an average interest rate of 7% on our outstanding debt, the U.S. government would be paying over $1 trillion worth of interest each year. Now, if you add $1 trillion to the deficit while you're collapsing the bubbles in bonds, stocks, and real estate, you're in for a very, very rude awakening.
You're saying that people should get ready for a rude awakening. So how can people prepare for the coming crisis?
Well, one thing, you shouldn't buy into the Fed's BS about being able to normalize interest rates with impunity. So for my investors right now, we own about 15% of the portfolio in precious metal shares because we believe the dollar will fall over time as the Fed runs into a stumbling block. As I mentioned earlier, we had 98,000 net new jobs in March. Now, everybody's blaming the weather for this phenomenon, but I don't believe it's weather-related. I believe the Fed has been in tightening mode since December of 2013. And if your audience will remember, December of 2013 was the beginning of the Fed's tapering. And tapering its QE purchases was indeed tightening. They went from $85 billion worth of monetary base creation all the way down to zero by October of 2014. The Fed has since raised rates 3 times. So the Fed has been tightening all this time. The yield curve has been collapsing all this time. And I believe another few rate hikes will send the 2-10 spread to zero. You'll have a flat yield curve, and the recession always follows a flat yield curve. That'll also blow up the stock and bond prices and real estate prices. So, as I said, own some gold. I would be long dividend-paying stocks right now because we're not going to have a reflation trade. I would definitely own aerospace and defense stocks because we have a wartime consigliere in the White House. I think Donald Trump is a wartime president, and he's not at all afraid to use his arsenal, as he proved last night. So you want to own some exposure there. And other than that, you want to have a lot of cash. So precious metals, cash, defense stocks, and dividend payers will get you by until the yield curve flattens out and the break-even spreads collapse. And then we'll be in the middle of 2008, and you want to be, in that case, short the market, and that's where my investors and I plan to be.
Now, what about for retirees? What unique risks do they face?
Well, they're probably not going to get the Social Security or their pension, if they have one, in real terms. So I believe that once the recession manifests itself later on this year or early 2018, the Fed resorts to something known as helicopter money. And what that means is that instead of just buying assets that exist in the primary dealer's vaults, which is actually just creating excess reserves that lay fallow at the central bank, they will directly monetize assets held by the public. In other words, they will directly monetize treasury debt. The government spends massive deficits handing money to citizens, and that is directly purchased by the central bank, or they directly send the money to citizens. They don't even use the treasury. They just, tax refunds or direct deposits, mailing checks, put them in your mailbox. So I believe helicopter money is coming, and that means you're going to have a real reduction in your purchasing power. So senior citizens who planned on, if you're 70 plus years old and you planned on receiving a pension, that is not going to happen, in my opinion. If you look at the underfunded pension situation in the country, it's very dire. And if that's the private pensions, the public pensions, Social Security and Medicaid, they are also in dire straits. So you're going to have an active management of your money. You have to know when to invest for deflation and when to invest for inflation. And in that, if you have a good manager that knows how to do that, knows what I'm talking about, knows how to model that dynamic, you'll hopefully be able to provide yourself with a real return after inflation and after taxes.
All right. Well, Michael Pento, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, my website is pentoport.com. My email is mpento@pentoport.com. The office number is 732-772-9500. I think you still have time to prepare. That's my final thought. You still have time to prepare. Again, they solved nothing. The government has solved nothing. They took a distortion in interest rates that would have caused a minor depression in 2008, and they really put all their money on a mass exponential increase in the distortion in interest rates and the distortion in asset prices and a massive distortion in debt levels. We have a record amount of debt and a record distortion in asset prices. So there's still time to prepare. If you have a good money manager, he'll be able to hopefully navigate you through these very treacherous waters, which are indeed, unfortunately, very close.
Once again, Michael Pento, thank you so much for your time.
Thank you for having me on, Elijah.